Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. Set up Sunday. Let's take a look at some not so bullish charts. We're in a difficult time for technical analysis to be correct. Technical analysis here, almost across the board, is very bearish risk on markets. The macro trend is still bullish. We're still above the cloud. I'm not worried about the cycle. I'm not worried about anything in 2025. But we are at a time which high time frame, long-term ideas are not the play here for the long side. Based on my system, based on the cloud, this is flashing, get out of your longs. It's time to take a break. If we look at the bullish TK cross period, price above cloud, bullish cloud, up until now, that is a great move. We had a catalyst for that being the election, and that's that. I have some numbers in a spreadsheet on this in a second, but if we look at all of the bullish TK crosses, post-halving, pre-halving, yada, 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 it's going to take some time for this to either break down, remain sideways, or move higher. It's probably going to take us closer to Q3 than now. One other thing to note here is if you're bullish on 10 things that could happen, right? Name them, I don't care, whether it's SBR, whether it's a Plaza Accord type deal with devaluing the dollar, whether it's a Cambrian explosion of policies that are bullish for crypto. All that stuff is possible. And I think here, you as an individual need to say, do I think that's going to happen? Yes or no within the next week or month or quarter, and allocate appropriately, or do nothing, or sit in cash, right? Those are kind of the options here. If you think an SBR is a 50% possibility, maybe you're 50% cash here. But unlike the election, where the technicals were correct leading into the election, technicals were optimistic leading into the election on both legacy and crypto, might I add. Small caps were up, banks were up, regional banks were up. Everything was already leaning bullish, whereas here, everything is already leaning bearish. Now, the technicals can be wrong, and like I said, this might be a difficult time for technicals to be correct because of the inauguration and the regime change on the 20th. But the technicals here are very clear. This is long exit territory. This isn't short territory yet, but it is long exit territory up here. And that could very well be wrong. Last week, I was talking about a few things, including the potential of building out some sort of inverted head and shoulders here on kind of a monthly basis. That's still possible. We had the worst of all cases where we had a breach of 100 and then got smacked down all the way back to support. Support has held. It's been a massive mess here on low time frames above 92. But the viewpoint, again, is clear. It is bearish. That could be wrong, but it is bearish. End of story. There's no question here that this is bearish for the trend post-October. The TK cross is telling you that this has been momentumless for at least 60 days, and the opportunity for weakness beyond what we've already seen is high. The probability and possibility is high. If we look at a potential trade setup here, it would be a candle close inside of the cloud, which could be late on the day. For instance, if we break from 94 to 80 in a day, which I don't think is going to happen, that would be late. If we break from 94 to, let's say, 90 or less in a day, and the trade trigger risk-reward ratio is garbage, that is also late. Ideally, what we're seeing here is a slow drift quietly into the cloud with a close on the day around 94. But once again, the setup here is clear. For people who've been with me for a while on this channel, they know this is an edge-to-edge setup, an edge-to-edge trade. This happens very, very rarely. It happens at the end of bear markets and occasionally throughout bull markets. You have three things here pointing to 80 as support. That includes the yearly pivot. That includes the 20-week moving average, that yellow line there, as well as the bottom of the cloud, which would just be a vanilla edge-to-edge move here. One way to play this would be to set bids around the 80 level, both above and below, depending on confidence that we'll get there. It's possible but unlikely that we find some sort of pit stop here in the 80s. Depending on your confidence of that, you'll put bids there. I just think the highest probability level if we start to break down is 80. And this isn't even talking about the head and shoulders stuff at all on both BTC and the S&P and most things right now. Where is this idea wrong? This idea is wrong when it makes a higher high, which in this case would be like 102, 103. So you do have a little wiggle room here. The first stop loss would be the Kijun, the second being 100K flat psychological level, and then the third being the previous high, the previous local high. If we get all the way back up there, the case for price breaking down diminishes significantly. But if I had to take a trade today, based on the information I have today, it would be sitting in cash, waiting. waiting for either a break below 94 into the cloud or a move above 97, 98, 99, 100. This is just the technicals. It's important to remember. The technicals do not care and do not know anything about the calendar. They don't know anything about the inauguration. They don't know anything about the next president. So that is where this could easily be wrong if we get some sort of announcement regarding an SPR. That's not me hedging. That's just saying, look, this is the reality. But the technicals are clear. The technicals are bearish. Because people love backtesting, let's take a look. If we look at all the times over the past 2 years we've seen this type of behavior, this type of edge-to-edge activity, most of the time we find support around either the 20-week moving average or the cloud. If we fail both of those, we are probably in for some extended consolidation like we were in July. If we see intervention on something for whatever reason, let's say because the 10-year yield gets above 5%, S&P breaks down, BTC breaks down, and then we get some sort of intervention on liquidity or yield curve control or QE, whatever it is, then I would expect to see something like the SVB situation, which was in March 2023. Depending on, again, your probability of that event occurring, maybe you pre-position in front of that. But to expect a bailout effectively ahead of the event, you may be a bit early, but it's something to watch for, certainly. Looking at the 2017 bull market, similar situation. We typically have found support at or about the 20-week moving average and the bottom of the cloud. We also got in 2017 very quick reversals around those levels. So if we're truly, truly bullish, what we don't want to see on this breakdown is just sort of sitting around 80, waiting to see what happens. Similar to August, July, September, where we just kind of sat down there, and kind of similar to, if I have it on here, similar to this period, also July, September. I don't think we're in the time period for this lull below the 20-week moving average. So that would be unusual to see that. Add that as a fourth reason that we'll probably find support around 80. Now, if we look at all of the TK crosses, both bull and bear, pre-post halving, that were price above cloud, and we're measuring them based on days, based on percent move. You're looking at the green to red, not the red to green. That's important. White being the halving. This gives us an average expected bullish TK cross somewhere around the 25th of February. We'll take a look at the spreadsheet on this in a second. But for the most part, we do not see these back-to-back-to-back-to-back quick TK crosses. I've excluded this period specifically just because it would mess with the averages. But this period here, again, Q3, not exactly where we're at here, but a possibility where the cloud just has no idea what's going on, right? Where we're up or down, massive range. You could argue if the 69,000 BTC to be sold is sold, maybe we get something like that. If it doesn't end up in the SBR and it's sold anyway, right? You can make this decision tree where it's possible we get sort of this Germany style selling event, but I wouldn't give that high odds here currently. Pre-post 2020 bull market, same thing. TK crosses mapped out. There's halving 2020. We do not get these TK crosses often, typically about once a quarter. And the bull markets tend to be over after a multi-month run, at the very least an extended pause. And then if we look at 2017 bull market, we had a series of very long periods of bullishness before the end. So if we map all those out, put it in a table, average duration of the bullish period in the TK crosses, somewhere around 84 days, average gain around 56%. That includes the post-bearish periods, includes everything. So there's no outliers removed there. And then if we look at time to bullish TK cross after bearish TK cross, excluding the bear market, it gives us about 49 days. And that's where I get that February number-ish around the end of February. A few other things pop out to me here. If we look at the last period, it is above the average in duration and below the average in percent gain, which is fine, just kind of interesting. Between halving periods in the bold here, we've seen 8 TK crisscrosses. We're only going on the third, potentially, post-halving. All the more reason to remind everybody that this is probably going to be a marathon, not a sprint, and to just cool your jets here because we got some time in 2025. We can also look at basically the forward expected performance. When you get these positive periods, with the TK crosses, they're mostly not noise. Again, I've excluded 3 specific instances here to make the data look a little better. I would have excluded it from the percentages anyway. But for the most part, these crosses are mildly negative and very positive when they are positive. That's why I pay attention to them at all. And then the last thing I'll mention is when we get these string of 8 bullish TK crosses between halving periods, we usually get one very large move here, right? We got that 210% move in 2017, that 370% move in 2020, and we've yet to see that. No promises we'll see anything like that ever again, obviously. But despite what we've seen so far, pre and post halving, a couple of 50%ers, we really haven't seen anything super crazy just yet. Another thing we can look at is the lead lag time. I'll take a look at M2 in a second, but the lead lag time between gold and BTC. And just looking at the cloud here on gold, it has failed to break down. It has failed to break through the cloud, which is good for BTC. BTC typically lags gold. Gold is, I think it's something like 30 to 90 days ahead of BTC. But gold is poised for a bullish TK recross here on the cloud. That's following 45-ish days of flat. So this is what BTC could look like around 80K, 80 to 95, where we try to stab down. Maybe we get there, maybe we don't. We don't go much lower than the cloud, and we just kind of hover around this mess of an area until we get an answer. But this is a very good sign for BTC if gold is holding up like this at around 2,700 currently. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures, Inc., PVI, DBA, Kraken. Looking at the volume on Kraken today, seeing XRP at the top is certainly odd. Not something we see most of the time. In a vacuum, the XRP chart continues to look fine. Everything outside of BTC is just leveraged to BTC most of the time, which means most of the time this stuff's all correlated. In bullish periods, you get dispersion, you get anti-correlation, you get inverse correlation, whatever. But the real question here is, if you're bullish alts, what is your confidence that if BTC breaks down, the alts will not get dragged down with BTC? The only other chart that I like here, just on trend, not on as far as a trade or a setup, would be SUI. It's continued to just hold these levels and look great relative to everything else. Again, not a trade here. I don't see a setup here. The trend is still intact and certainly looks better than BTC does. It's also important to remember the previous chart pattern, the previous setup, the previous range, the previous expected move. We have hit that to a T from the breakout. Generally how this works is you get consolidation, you get chart pattern, you get some sort of setup. It's a yes, no. We got a yes. It was a conclusion that was expected and the move was expected. So the next step here is a repeat of what we saw previously. We get a range, we get a question and answer, yes or no. Is this continuation? Chart pattern says no. A completion on this would be sub 92 as far as the breakdown. But this range consolidation currently certainly doesn't look bullish to me and is more reminiscent of the Head and Shoulders than anything else. On top of that, if we look at the pitchfork, along with the expected move of the pattern, the expected move on the pitchfork is also where we hit. Can this be wrong? Of course. We could just pop to 10,000 tomorrow, right? But the technicals are suggesting a drift back to the midpoint of this pitchfork is more likely than breaking outside of this. If you think about the sun and gravity and planets rotating around the sun is the midpoint. The planets are rotating around this midpoint constantly, right? So it's going to take a meteor or something wild to get us out of this gravitational pull of the midpoint. Not a great risk reward setup here to the long side. On the power law corridor, we're at the midpoint still here. And typically what we've seen in these post-halving periods in the power law corridor, we have some trouble getting out of this midpoint. This is 2020. It took a minute to finally push higher. And if we look at 2017, it took some time to push higher. So if we're trying to level set expectations on what we've seen previously and what we're seeing now, yeah, it makes sense that we're stalling out a little bit before a potential bigger leg occurs, whether that's in Q2 or into Q4. Stalling out here certainly makes more sense on BTC than just blindly continuing. A really good sentiment gauge for BTC has been MSTR, which I think has been leading pretty consistently up and down for BTC. So if for whatever reason MSTR is above 350, that's a very good sign for BTC. I highly doubt these will go in opposite directions, as MSTR is generally just leveraged BTC. So if you're bearish, you want to see this breaking down towards 250. And if you're bullish, you want to see this above 350. It's really that simple. I don't see a great trade or setup here until we hit those levels, frankly. It's just kind of a random walk based on the technicals alone, nothing else, right? It's important to remember. You can incorporate anything you want outside of the technicals, that's fine. But the technicals here are telling you certainly that it's more bearish than bullish. So that's BTC. And if BTC looks like it does, I wouldn't expect anything on the alt side to look bullish at all. That's why to see Ripple and SUI fairly bullish is an oddity, because most of the alts look like ETH, where it's just nothing. Nothing happens. It's been bearish on the cloud for a little while now. If you're trading ETH, if you own any ETH like I do, I own a little bit of ETH, then you are in it for this idea and this idea alone, which would be a break from 4K to somewhere 5 to 7 to 8, whatever, somewhere up there. You're hoping for some bullish headlines in 2025. You're hoping for anything, whatever it is, right? ETF, staking, in-kind, blah, 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 blah. Doesn't matter. Whatever it is, you're hoping for it and you're on board and you're ready to go. In the near term, I like 2,800 as a level where this could go, leaving the pattern intact. But I would not expect anything on this, on ETH, for a minute here, as long as BTC is bearish. And the ETH BTC idea is also at risk and needs a bit of a miracle to remain intact. Ultimately, it's not really go time on this until it's back above the daily cloud, which it hasn't been since June. So that's a good sign. That's the silver lining, that it should be easy to spot once this is back above the daily. It hasn't been above the daily in a long time. It is quite the mess down here. Quite the mess. Is it a diamond bottom? Is it an inverted head and shoulders? Is it anything at all? I don't know. Certainly I was hoping that this would have continued to pull up, and it did not. So definitely more bearish than bullish on that one. Sol also looks like a steaming pile of nothing. It is back below the cloud, bearish TK cross, bullish cloud. It's just a mess. There's nothing here at all. If you're trading this on any chart pattern, you're trading that on a multi-month time horizon. There is no fresh new idea here that's bullish. There's just not. You could argue there's a cup and handle here. You could argue there's a monthly version of an inverted cup and handle here. There was a head and shoulders up here. It's just not really done much of anything for a good long while. And the signals are all over the place at the moment. Not something I would touch. So that's crypto. And on legacy, everybody's watching this. Everybody's watching the 10-year yield. If this goes above 5%, things probably break. If you're sure we're going above 5%, you're probably not sitting in 100% crypto. If you are, you are hoping for some sort of intervention or liquidity intervention above 5%, which is fine. Everybody can play this however they want. Or you just do nothing and you just, eat the downside. But if this continues to move higher, then things are going to get interesting. Maybe this is a rising wedge, maybe it's not. But it's certainly not bearish, I can tell you that. And if we look at the DXY, same deal. Is this a rising wedge? Maybe. Do we get a blow off top here? Maybe. I don't know. It doesn't look bearish at all. And this is challenging everything. Liquidity, it's challenging earnings. Specifically, the yield stuff is challenging earnings. And then the other horseman would be US oil, which continues to move higher. Never quite got the breakdown at 70. And normally the three things are pretty correlated if we look at DXY, the 10-year, and oil. And you could argue that if oil, in this case, moves up to like 80, 90 region for whatever reason, which doesn't seem feasible, but if it does, add that fuel to the fire for risk markets to get angry. But all of this is a massive headwind for BTC and crypto, specifically alts more than BTC, but definitely BTC. If we look at what's just happened since 2023, M2 leads BTC. M2 is the money supply. If M2 is declining by a lot, which it has been for a while, and nothing has happened, right? But eventually we reach a point where it just becomes harder and harder and harder to do anything. You could argue, as many people did, that in Q3 time period last year, as M2 was breaking out, it was time to get bullish on BTC. So this lead lag relationship, should it continue, should very easily pull BTC lower. What does an SPR do to this? I don't know. Probably what it did in 2023, where we got ETFs and that lead lag relationship broke down a little bit. But M2 declining is not bullish for BTC. It's not bullish for alts. Full stop. So for instance, again, if the 10-year goes to 5 or higher and we see an intervention in liquidity, that would bring M2 higher, that would bring the dollar lower, and that would be a positive event for BTC. Many people are certain that this will happen. And if you're one of those people, then you're pre-positioning ahead of that, just continuing to buy BTC, not caring at all. Hodling on, as they say. Looking at the bond complex, all this stuff looks horrific on trend. It is all set to move lower. TLT, the worst of the bunch. This is, of course, inverse yields. So as yields go higher, prices on this stuff goes lower. And there certainly is not a trade here to the long side on any of this stuff. Even if this bounces here, as a trend trader, none of this is a long at all. All of this looks quite bearish. High yield debt, HYG, also leaning more bearish. I mentioned this one specifically because it's typically correlated with BTC and liquidity, and just add this to the pile of bearishness. You can certainly see the BTC chart from October in this chart. We have 2 spurts of bullishness on HYG, and that's kind of all we've gotten in BTC as well. And right now, this is not bullish. And lastly, of course, the S&P, which broke down Friday, made a new local low there below support, closed inside of the cloud. And again, if I had to take a trade on this today, a short would be a little early based on the cloud, just because we don't have a bearish TK cross yet. Similar to the March-May period, even back here into September, when you get these early dips into the cloud before the TK cross, you tend to have price pull up a little bit and then it kind of gives up. But it's not bullish. This is clear. The edge to edge move for this would be 56.10. So if I had to pinpoint the weakest week that we are in limbo, it would be this week. I don't think we're going to 80 this week, let's be clear, but we might try to go to 80 this week until we have some policy intervention or whatever on the 20th. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.